Today, we have two awesome panelists. First is Keith Cammey. Keith is a managing director at Techstars and has been at Techstars for 5 years. Before joining Techstars, Keith was an entrepreneur for over 20 years, including one company for which he raised over $50 million in venture capital. So I guess you could say he knows a thing or two about this topic. On the other hand, Keith also had a company where he raised no capital whatsoever. So he can also talk about what's great about avoiding venture capital altogether if you're able to. Supporting Keith is going to be Najee Barnes McFarland. He's an investment associate for our Techstars Silicon Valley programs. He leads sourcing and selecting for the program and previously worked as a consultant helping a handful of early stage founders raise over 15 million in seed and Series A funding. Fun fact about Najee is that he considers himself a recovering entrepreneur in the climate space. I'm delighted to hand it over to Keith to talk about getting ready to raise capital. Keith, take it away.
All right. Thank you, Dylan, and thank you everyone for joining us. I am delighted to be here. As Dylan said, I'm a managing director here at Techstars. I run a couple of our programs, including the Techstars Future Longevity Program, which is funded by Melinda French Gates' Pivotal Ventures, focused on all things for older adults and the people who care for them, and a brand new program, Techstars Economic Mobility, powered by Samvid Ventures. And that is a new program focused on solutions for supporting the economic mobility of low and moderate income Americans and helping them advance. And so one quick plug, and then Najee, I'll let you do a plug before I go into the presentation as well on your program. But one quick plug for that is that we have 1 day left in our application cycle. So if you do have a company that's working in that field, and if you like what you hear today, then you might consider putting an application, and you can just search Techstars Economic Mobility and find our program in that application. Najee, if you want to say a little bit about the program you're working on, and then I can go into some presentation, and then we'll open up for Q&A at the end.
Yeah, no, that sounds great. Thank you, Keith. As Dylan said, I'm the investment associate over at the two Techstars Silicon Valley programs, one of which was just announced more widely, but it's Techstars Oakland, powered by JP Morgan, which focuses on underrepresented founders in the fintech, health tech, ed tech, and climate tech spaces. And then the other program is the Future of E-commerce, powered by eBay, where we'll be focusing more on the infrastructure layer of commerce tech, or so that includes like things like AI, machine learning, cybersecurity, data infrastructure, augmented reality and virtual reality, cool things like that. Our applications closed July 5th, so you do have a little bit more time than Keith's programs, but feel free to check it out or find me on LinkedIn and we can chat.
Good. Yeah, we're looking for founders to move really fast for our program, so that's what that's all about. I'm going to go ahead and share some slides. I'll take probably about half our time here going through some content for you, and then we'll open it up for some Q&A. And this is ultimately a summary of a good 2 months of our 3 months of an accelerator program. So it's going to be a bit of a whirlwind, and I'll give you some information on how to find more information. And obviously, if these topics are of interest, then an accelerator could be for you. I'm gonna go ahead and share my screen here, and hopefully the slides are working. Y'all interrupt me if they're not. But let me take you through. And for context on this is one of a 3-part series that Techstars is running on fundraising for you. And this is really, again, terrific content and draws straight from what we cover in the accelerator. So I've got this week's one. We're going to start with the get ready phase. So the idea is that fundraising is a process. You don't want to kind of dabble at fundraising. If you're in, you're going to be in. I'm going to talk about that at some length in this presentation. And this is all about the steps that you'll do before you even start the raise. And then next week, we have some other folks who are going to come in and talk to you about preparing your materials that you'll use for your raise, and then ultimately get into the mock interviews when you do land a conversation with an investor. So that's where we're headed. And today we're going to talk about clarifying where your business is headed, how to explain it to investors in a way that's going to resonate with them, and then ultimately how to secure meetings with some of your target investors. Before I even jump into that, some considerations though, and before you commit to fundraising, and maybe I should call this the let me talk you out of fundraising before I talk you into how to do it section of the program, but just a few quick things to consider before you even hop into VC, and we're talking about venture capital type fundraising in particular here. And so the first thing is, should you be raising capital? Should you even try? And so the question here before you bother, like think, and again, this is for venture capital in particular, a particular class of capital, but you want to be able to build something that can be significant. If you're building something that doesn't have significant scope and scale, it's probably not going to ultimately be venture backable. Are you going after a very large market that is growing, or some way that you can disrupt an existing big market? Do you have a good plan for using the capital? How do you get from where you are today to the next major milestone? Investors are not looking just to extend your runway. If you're just saying like, oh, this amount of capital will give me 12 months of runway, that won't be particularly interesting to an investor, because they don't want to just help you keep the lights on. They want you to create more value with their money. So we'll talk about what that looks like in the milestone planning, but do you have a game plan for what to do with this money if you get it? It's beyond just, funding current operations. Do you want investors as your partners? They're going to come with advice and have some control. So think about whether or not you want that support. I found it very helpful to have my venture capitalists as support and board members in one of my companies. And I loved not having venture capitalists in another one. As Dylan mentioned, I've done it both ways. Are you prepared to go big? Meaning, or you're starting on a growth path here, everything's got to stay up and to the right here to keep attracting capital, and probably your first round of capital isn't going to get you all the way to profitability. So the idea is that you're really going for it by committing down the venture capital route, and not trying to build something that'll just sustain your earnings that you'll stay in necessarily for the long term, but something that might be exitable. And is the timing right? Is the timing right for your marketing, your company to be out there? And are you ready to raise is the next question. So if you should raise, are you ready? Do you, again, have that venture scale opportunity that gets investors interested? Ultimately, investors talk about it this way. They're looking for home runs. They're not looking for singles and doubles, not something that can achieve, with reasonable probability, a decent size outcome. They're looking for investments because many companies don't work. They're looking for the ones that do work to be able to be really significant. They think of this as amassing a bunch of lottery tickets, right? So do you have the potential to create a massive payout for investors on the back end? And again, do you need more capital in the short term than you're going to get from customers? That would be a reason to go ahead and do it. And do you have some traction? Do you have some ability to explain that customers are interested in what you're building? Because if you can't get someone who's going to buy your product interested in buying what your service, interested in buying what it is that you're conceiving, whether that's really hard paying customers or some evidence that there will be customers once you finish building it. If they're not interested in your product or service, why would an investor be interested in buying stock in your company that's building that? So really think about what your traction needs to look like. We'll talk about that a little bit. Are you prepared? It's going to take a lot of time to raise capital. So is there someone who's able to keep the lights on while you're busy working on investors? And are you committed to the process? Finally, if all of that sounds a little daunting, there are very good alternatives, and I pursued one in one of my companies. I call that the keep it small, own it all model, and that can be quite lucrative because you end up owning all you end up owning the whole company, and you end up being able to grow and keep the earnings and not have to take someone else's investment considerations into consideration for where you want to go. So if you want to consider that, think about whether or not you can finance this by your customers. Selling is a really good way to finance a business, including perhaps there's, prepaid revenue, or you get in 12 months of subscription up front. Can you bootstrap this? Can you pursue non-dilutive capital sources like grants and government grants? Again, front loading cash, factoring, friends and families, a business partner that you bring in that might want to buy part of the business from you and be a partner, and or just simply going a little slower and using the capital that you have. So there are alternatives to the venture-backed route. It's not for everyone. It does require a certain discipline and a lot of time commitment. And so think twice before you just jump in, because it sounds like a good thing to do. All right, if I haven't scared you, here's kind of what we teach about raising capital now. And I'm going to just go kind of whirlwind again through, ultimately a couple months of Accelerator programming. So what makes raising capital so hard? And I think that ultimately, and credit this particular slide to Alex Iskol, former MD and now VC at 2048 Capital. He's got a great deck on fundraising. But the way he summarizes it very effectively on the founders that are pitching to him for seed rounds is most founders rush into fundraising, they're unprepared, and they don't create the process that's going to support their efforts. And then he drills down into this, and then the comments to the right are mine. But the typical reasons that what lack of preparation looks like is that the company doesn't have traction or customers. The founder is not really a fit. Why, you haven't answered the why you. Not having a great go-to-market, not understanding the competition well, the business opportunity is too small, the KPIs aren't on track. Ultimately, that whole list is all about the underlying business itself. It's not about the process of fundraising. It's really, is this business investable? Have you given adequate thought to whether or not the business is set up for success? And then the other couple of reasons that get highlighted are really process questions. Are you targeting the right investors? Do you have your pitch and your materials down well? With that disproportionate focus on, the types of businesses that get funded are the ones that are actually good investable businesses. We like to focus on the Accelerator on first taking a step back and making sure that business is in good shape before you even go out for capital. And so when you think about the ready, set, go of investing, I think of the first step as figuring out where you're headed. We have different terms for this in different ones of our programs. I use the vision to execution mapping model for this, and I'll take you through what that looks like to take a step back and really think about how you're executing your business. This is a good exercise whether or not you're raising capital, by the way. This is good for privately held companies. This is sort of core strategic planning 101 applied to startups. Next is, how do you craft the building blocks of the story that you're going to tell to investors to get them interested in buying a stake in your company? And then the last thing we'll get into in today's presentation is building the pipeline of the target investors and how you get introductions into them. The other content's going to be covered in subsequent presentations. So that really sets up, again, if getting investment is really hard, what are the things you need to do to prepare to be more successful with it? It would be stepping back, building a proper business, and then really thinking through your messaging and who you're targeting. That said, it's still going to be really hard, but at least running a structured process is going to increase your odds. So everything we're doing doesn't guarantee an outcome. What it does is it takes the best practices and increases your odds of success, and recognizes that fundraising has a beginning, middle, and end to it. And then, when you decide to do it, when you jump into fundraising, realize it really is a full-time job. If you don't commit, your round is going to move slowly. It's going to meander. You're going to have meetings here, meetings there. You got a toe in the water. It takes too long. Investors will start getting a negative signal that, oh boy, this is taking forever. Maybe that means there's something wrong with it. So it'll produce slow outcomes, and it'll produce worse outcomes than if you fully commit. Or better put by the great philosopher Yoda, there is no, you either do or not do. There is no try here. So jump in or don't jump in, but really do that evaluation first of whether or not you're investment ready. All right, with that, before you raise, let's clarify where the business is headed. So we're going to go through clarifying where your business is headed, how to talk about it to investors, and then how to seek investors who might be interested in what you have to say and get introductions and meetings with them. In an accelerator program, what we do is we call this the slow down to speed up section of the program. And it sounds like an oxymoron, but it is incredibly valuable and really important. And again, whether or not you're trying to raise capital, this is absolutely key. This is taking that step back to say, am I working on the right things in the right ways and tying what I'm trying to achieve to what I'm relentlessly executing week to week, day to day within the business, and getting everyone aligned against it. And taking that step back for a moment really lets you evaluate if you are working on the right things that are going to get you momentum to where you're trying to go. And the way we do that in programs, we focus the first month of the program on this. We first spend the first week on, again, what I call vision to execution mapping. I'll show you what that looks like, where we look at the big goal, we break it down into a couple milestones, and then get down to the KPIs you're trying to achieve, and ultimately what you need to execute every week to make progress towards those, so that you are in fact executing rapidly as a company and can make that case to investors who want to see that you can rapidly gain traction. Next, once you've kind of redirected your business by pressure testing that and doing it both in the strategic planning exercise and then with a lot of mentor involvement, helping you see around corners, you start building traction against your business plan. And it might be a modified business plan. The beauty of mentorship, and again, we do this intensely at Techstars. We consider this a curated mentor-based journey. After you spend that first week building your vision execution map, we want you to pressure test it. The beauty of that is that mentors have been through the drill before. They don't have crystal balls, but they've seen it before in some version or another. It's more like, I've seen this movie before. I know how this ends in certain circumstances. It's not a perfectly predictive of your situation, but someone who's been in the market you're targeting before might be able to say, hey, you know what, that particular segment you're thinking about that you think looks really attractive for your product has a lot of roadkill in it, or a lot of competition, or there's regulatory barriers, but what you're building could be really valuable for this other segment over here. And why don't you try that? And in fact, I know some people who could help. So if you do that in the Techstars program, we kind of spoon feed that, and we surround each program with a lot of mentors who work with each company. Even if you're doing this without an accelerator, though, I encourage you to do that outreach and really pressure test that you're working on something that'll be valuable. And I'll tell you from my own experience with my company that raised a lot of venture capital, I wasted a couple of years on this. I twice went down markets that looked like they were good without adequately pressure testing it, and probably mentors from the category would have figured this out. And I've talked about this before in our AMAs on what those segments were. We ultimately hit on the right segment the third time around, and then took off like a rocket ship, really, based on finding that product market fit for the right segment. If we had slowed down and taken that time to ask some mentors about what we were working on, they probably would have been able to predict that we would have run into some problems on the categories we were going for. Once you commit, you want to spend a lot of time working on getting traction, and then ultimately you get into your investor readiness and your prep. And so that's what the 3 months of program looks like. That's what your process ought to look like, even outside of an accelerator. Let me tell you what I mean by vision execution mapping. These are all workshops we do in the program. I won't belabor them, but here's a process you can do yourself. And there are plenty of resources on this. I'll offer to send a link to a document version of this for anyone who wants, and I'll give you I'll put this out on Twitter afterwards. I'll give you my Twitter handle on the next slide here. But what we want to do is we want to start broad. We want to start with your core guiding principles and what you're trying to achieve. What's your vision for the business? And what's the big, hairy, audacious goal, which is basically saying, if this works, how big could it be? And so try to quantify it at some future date. How big is this? What does it look like? What have you achieved? That big, hairy, audacious goal, you might not be able to fully build a map to exactly how you're going to get there yet. That might be 5 years out, 10 years out if this goes really well. But that's setting the groundwork. What that does is it both creates a North Star for your business, makes it clear where you're headed, and it also helps you enlist others in your journey. By being clear about your vision, you can get others, whether it's employees or customers or investors, who might share that vision to want to join you in that. But then we got to get real. So now that broad visionary goal has to turn into something you can execute against. And so how do we do that? We do that in two major milestones. First, and this is really important for fundraising. This is a very important concept. You're not just planning this raise. You want to plan 2 raises out, because the purpose of any given raise is to get you to, unless you're going to get to profitability, that could be your milestone number 2. It might be that you get profitable on this raise. But if not, you want to know how far the money that you're raising now is going to get you and what you plan to do with the next round. And so we like to look 2 rounds out, or milestone number 2. In corporate strategic planning, they usually do 1 year and 3 year milestones for this. But in a venture-backed company, it's really kind of round to round you're working on, your seed to your Series A, for instance. And so you want to know the dynamics of where you need to be very specifically to achieve your second fundraise. And your next fund, the people who are looking at you for milestone one, your current fundraise, they want to know that you can get there, because they don't want you to run out of money without being investable by the next group at the next valuation up. So we spent a lot of time on that. And within that, we want to know who you're selling to, why they're buying, and what it is they're buying, what your revenue formula is, how you're going to pitch it. You start getting more concrete here. And then ultimately your traction. So this is now your current, from this broad vision to your second milestone out to what you need to achieve right now in the next 3 months, 6 months, 12 months to get to your immediate next fundraise. And get really concrete about who the target investors are, what they look for, how much revenue you need, what traction you need, where you need to be, what the team needs to look like. And we really detail that out and start building the KPIs, OKRs, and assumptions around that. This is something that you then can execute on week to week, month to month. And we want you to become kind of relentless execution machines, making progress every week against certain goals. You're going to set some goals for the week, execute on them. Maybe your goals happen or maybe they didn't. You're going to learn something either way, but then you repeat. That bias towards execution and making progress all the time is both good business, and it will also set you up really well for investor conversations, because you'll just be tracking quickly, and that's something that investors really value. Put another way, or to summarize why do that exercise first, is that, you know, sometimes we see visionary founders, but who have no real thought of like, so how are you going to do that? So vision without action, action is just a dream. Sometimes we see founders who are just executing. It's really interesting, but it's kind of all over the place. Like, why are we doing this? What's it going to lead to? I'll figure that out later. Action without vision is just passing the time. You're just doing tactics. But vision with action together can change the world, and that's kind of the goal. So we have a document on this. We summarize this all down to a document for vision execution mapping. Each one of these has a workshop, and I've got some tools so you can do some of this on your own with books and other materials on, for instance, Techstars Entrepreneurs Toolkit. It's not posted yet, but if you want to follow me there, I promise to send this out after the presentation, so you can see the document we use in program and try to do it yourself. And I'm going to continue moving quickly because I want to cover in about 10-15 more minutes the rest of getting ready for investors, how to talk to them, and how to find targets that will take your meetings. So I'm going to leave the vision execution mapping here, but just know that we spend a whole solid week on this in an accelerator, and then pressure test it for the next month after that, because it's really that important to make sure your business is on the right trajectory. And improving your trajectory can dramatically improve the ultimate outcome. The little nudges early on can change the vector that you're on, and cause a far faster and far more successful path to an outcome. All right, so you got that done. You understand where you're headed as a business. You understand what you need to do. You got the execution side of it done. Now, how do I explain that to an investor and make the case to ultimately give you capital to help you achieve those goals? And it's kind of two sides of the same coin. Everything you're doing in the vision to execution mapping exercises to run a great business is what you now need to communicate to the investor on why this is now a really investable business. So it's really the same exercise, but we're going to work on how to explain it in terminology that the investor thinks about. And the hack for this, the cheat, is to begin with the end in mind. And by that, I mean, a way to think about this is to know, how is an investor going to evaluate you internally within their investment fund? When they're talking to it, they meet you, they like you, they're going to talk to their partners in their fund and make a decision about writing you a check. Most typically, whether they explicitly commit it to writing or they just think about it in these terms, they create an investment memo. And that's an outline of, that's essentially a write-up of what your company does, and how they think about it as an investment opportunity against a bunch of different criteria. And that's our internal document. That's kind of a decision-making document, and something they put in the file afterwards. That we do this at Techstars too. Something they put in the file afterwards to say, hey, how did this track against what I was expecting to have happen? Where did we get it right? Where did we get it wrong? What are all the criteria we like to think about internally before we write a check to someone? So the hack here is, rather than waiting for them to write that up about you, write your own version of what you wish they would come up with. You may even be able to give it to them at the right time. Certainly a lot of the fields that you see on the Techstars application form are taken from investment memo terminology. But having your own internal version of this effectively serves as your message guide. Every time you're creating tools for an investor or talking to an investor, this is no different if you've done work with the press before. You'd have a PR talking points. Well, that's the points behind what you're going to say. It forms the basis for your press release and your talking points when you're being interviewed, so you can stay on message. No different here. You want to know what the end point is and how to describe your business to an investor. Well, let's see what they're looking for and make sure we're answering all their questions. And then that forms the basis of building your other tools. And the toolkit, which will be, again, gone into in some other sessions coming up in the future, include things, first of all, to get the meeting. So you have a one-pager, you have a forwardable that helps you try to get the meeting with an investor. Then your pitches, when you are talking to an investor, what would you say to them? What does that investor deck look like? And how do you say it in different lengths of time? And then ultimately your drill down materials, your data room, your financial model, and so on, built off of your KPIs and your revenue formula. So you can Google this. You can find different versions of different investors' investment memo. In our program, we use it's about 16 different fields that we use. They're most typical, least common denominator, greatest common factor of what different investors that we've talked to at the seed stage tend to look for in an investment memo. And think of each of these answers as being, it can be brief or up to a paragraph or two, but it's ultimately reverse engineering the document that they're going to write about you. So we're going through the company description, problem and solution needs to be really clearly articulated. Who's the team? Why are you uniquely capable of being successful in this? Why you? Is it a big market? This is so important. And working this both bottoms up and top down, meaning like find something that scopes out how big the market is generally, and then also multiplying up, the number of customers that you can address times your selling price and try to get those to triangulate in. Yeah, understanding the competitive landscape and what's your unfair advantage. So be surprised by how many companies don't actually do the basic Google search of who your competition is before you jump in and spend a lot of time on it. But you don't want an investor to be able to quickly search and find a competitor that you weren't thinking about. So understand how you differentiate. And it's good to have some competition in a market. It validates that it exists. Now you want to be differentiated, but if the answer is, oh, no one's really competing, then the question might be, well, if no one's even competing with this, if no one else is thinking of it, is it really a good idea? Because probably if it's so clear that this is needed, others are thinking about it too. So don't shy away from talking about competition, but certainly cover how you fit in and are different. Your business model, how do you make money? What traction do you have? Your go-to-market plan, et cetera. And again, so this also in that same vision execution map document, I've got this summary of yours in the second half of that. So if you, I'll put that out on Twitter afterwards. And again, so this is all stuff to do before you even talk to investors. Because your conversations, your tools, everything is filling in little pieces. This is your pre-answering the questions that they will tend to have, because this is the picture they're trying to fill in about you. So if you've at least given adequate thought to each of these, that you can answer these pretty concretely, whatever comes up, you'll be ready to go. And so that's beginning with the end in mind. Next time session, you're going to talk about how to build the tools against this. I won't go into that here, but once you've built the tools, and not before you've built the tools, next step is to go secure some of the meetings. And that's the last thing we'll cover here today before opening up to some question and answer. There is some material on this in our Techstars Entrepreneurs Toolkit. I think this is topic 16, goes into this in a little bit of length. I'm just going to go over it briefly and share some best practices with you and a little bit of a how-to on this. And again, this is building your list is part of the essential prep. And it's got to be a targeted list. I see sometimes founders will spend a lot of time building their tools. So great investor deck and a lot of marketing goes into it and really thinking through the other things, maybe the financial model, hopefully. But then quickly moves to, all right, so now let me go out and start talking to investors and randomly starts hitting a few of them. This is almost equally time consuming to building your materials, is figuring out who should invest and why they would invest, and really identifying those targets and how you're going to get to them. So there's not a great shortcut for this. It's really important hard work, and figuring out your target investor list and how to get to them is really important. So with that, there's a lot more material than this on the Techstars website, but let me give you a little. And this is, if you've had this experience of trying to knock on the doors of all the investors and spam them, you've probably gotten a response sort of like this, which is, yeah, no, Thursday's out. How about never? Is never good for you? And that's kind of the cold shoulder from it. Really, they don't answer the phone and even talk to you. It's just your emails are going unanswered. But that's kind of the symptom of an investor maybe not that interested because they're not targeted. And so finding the right target list is really key. So here's how. Building a target list, first of all, realize that if you do this well, you are in the top 1%, because most founders don't spend a lot of time on this and don't do it particularly targeted and well. It's going to make fundraising effective, but it's a real time commitment. You can't just breeze through this, and there's no single source of info for it. You can't just Google once and be all set, or get a download from PitchBook. And going for non-directed introductions is a waste of everyone's time. There's no good that comes from a cold email to an investor. It's not even good to ask for a warm intro if you don't know why that's a good target for you. So here's how, three-step process. First, build a prospect list. I try to target a couple hundred investors on the prospect list, because they're not all going to make it through from prospect to someone who really is a good target for you once you do the research. But the prospect list wants to be fairly targeted. And what you'll do is you'll build a spreadsheet, and your rows are one row per venture fund that you're trying to target, and then a bunch of columns, which I'll get into. But the sources of finding investors who could be a fit are widely available now. They shouldn't, this isn't the hard part. This is step one. So look at things like Crunchbase, PitchBook. There are many other data. You can just Google investor lists and you'll find some lists. But JP Morgan now has Capital Connect. There's Mercury, Open VC. There are a lot of others. Look at the conferences that are in your category and find out what VCs are presenting at your conferences. They're all targets for your vertical. Google searches turn up some good investors. Look up indirect competitors, people in your space, and find out who their investors are. You can look them up on Crunchbase and reverse engineer that, or you can just Google who they might be from press releases, and those could be targets for you. I wouldn't go after direct competitors, but sort of indirect competitors in your category. And ask your mentors, people in your network who might be good. But don't build an infinitely large list, because what's happening is each venture fund that you put on this list is not someone who you're going to reach right out to. This is just what every name you put on this is now getting you to have to do some research, and you're going to do some real research to get a good introduction. So filter it by stage. How big of a check do they write? What industries are they in? Where are they based? Do they like investing in wherever you are? Are they active? Do they have a current fund? You can, a hack for looking at this is see when's the last time they wrote a check in one of these databases. If they haven't written one recently, maybe they're not currently active. And so be selective on who you add to this list, because step number 2 is to now qualify each one of them. And there is no easy workaround for this. And here's the ultimate question you want to answer for each one of them on the list to qualify them in or out as someone you want to go after. Why specifically are they going to be interested in you, in your company? And so that's going to take a little sleuthing. Now, it's not super hard because venture funds don't want to waste time on companies that aren't a fit. So they're pretty good about keeping their websites up and broadcasting exactly what they're looking for. What stage are they playing in? What are some of the companies they're looking for? What are their themes? What's their focus? If you think it could be a fit, go a level deeper. Look at their blog posts. See if they blogged about something that you're working on. See if there's a really direct fit. See if they're on a panel or something, and you can find a way to connect directly to what they're doing. And if you can identify that, first of all, you're doing two things here. One is ruling them in or out as someone who you'd be targeting. And two is you're specifying exactly why they should be interested. And you're going to use that to try to get the introduction, whether it's through someone else or through navigating to them and networking to them, or in worst case, if you're going to go after a cold email, but that's warmed up by understanding exactly what they're looking for to give yourself some shot. You want to have some specific reason and some specific tie-in. I read your recent blog and we're working on exactly the problem that you're addressing there. I saw your investment in so-and-so. We're doing something related, not competitive, but related. And I thought you might be interested that this is on theme. You're doing two things. One is you're making your chances much higher of being on track with what they look for. And then number two is you're showing them, you're showing interest in them. You're showing that you did your homework. And that's music to the ears of someone you're reaching out to, just like it would be to you on someone trying to reach you. Next, find a path in. All right, so the ideal path is a warm introduction from a mutual contact who can validate you. What that does is it gets your email read. It doesn't guarantee you a meeting, but that reason for connecting will at least get read in the busy inbox. Another good way is to network in. That could be by going to a conference and connecting, and talking to them right after they present. Or finding someone who knows them through a conference or through a startup community. One way to network in is to go talk to founders who they've invested in and just try to get some information, not going and asking for the intro necessarily, but just saying, hey, I saw that so-and-so invested in you. They look like a great fit for us as well. Just wanted to pick your brain a little bit about what it's like working with them. And then if that goes well, maybe the founder's willing to make an introduction. But the point being that that's real work to network, and you do want to find some way that you're validated and not just spam. Finally, if nothing else works, sometimes a highly targeted direct outreach can. Maybe you connect on LinkedIn and send a message that gets quickly at the why they would be interested in you. And I saw your recent post, or I saw this, and I think we have something that might fit. Would you be open to connecting? That has a much lower probability, but that's a path in. And so that's really the third step. After you have identified why someone would be interested, you really want to find that path in, and first go for your warm intros. So in each of these cases, the case for why they're going to have to be interested in taking a meeting, because their most valuable commodity, second to only to their money, and sometimes equal to, is their time. And so they're choosing to spend their scarce resource of time on you only if it's a really good fit. And so in that forwardable email that your connection will send, you're going to make it clear to them what the why is on why they would want to connect. Whatever your outreach is going to make it really clear, and that's going to help get them potentially to go spend 30 minutes with you on a meeting. There's a lot of information on this in the Techstars Entrepreneurs Toolkit on how to build out that spreadsheet and what to look for. But the main takeaway I want you to have here, and then we'll wrap and go to some questions, is that doing the homework on who should be interested and why is the key to getting the meetings, and it is absolutely real work. So if you take nothing else than that away and say, hey, I'm going to commit to that and decide whether or not I want to go forward with my fundraising, when I do, I realize I got some process work to go and can refer back to this, then kind of mission accomplished for today. Kind of to summarize, and the big takeaway is that if in fact you want to raise capital, and if in fact it's a must do for you, then be really intentional on the process leading up to it, both in building a great company, understanding how to explain it, and identifying who to go after as distinct steps before you even get to the start line. So that's all about the getting ready to fundraise. The Accelerator, Techstars Accelerator, sort of spoon feeds that process. You can certainly do some of this on your own with some of the tools that are out there, the books that are referenced, and the website, the Techstars Entrepreneurs Toolkit website. And an accelerator is a great way, in my opinion, to short circuit the process and get a lot of support in doing it. Obviously, a lot more to it than that, but I'll leave it at that, so we leave plenty of time for some Q&A here, and I'll take down my screen share, and we'll see how the Q&A is going to come in here. Let's see here. I guess we have some participants raising hands. Is Dylan or Jessica, is this are these going to come in through chat, or where's our path to the Q? Oh, there's a Q button.
I see a good bit of them in the Q&A thing, Keith. I've been answering them while you've been talking, actually.
Great.
Maybe this is a interesting one. This is from Madison Feehan. What expectations do investors have for early stage seed level tech companies? What should we have upfront to help facilitate the process?
Yeah. Yeah, a lot. So a seed company, you're looking for kind of all the things we sort of covered there, which is a clarity on kind of your business model. You should have a fair number of things figured out by this point. So you should have some clarity on your product or go-to-market strategy. Your team should be well aligned to do this. You should have some traction against it. And ultimately some fairly solid materials to go after them with, and then be on kind of on theme for what they're looking for. I'm not sure if that was kind of the content of the presentation, so I won't belabor everything that was in there, but I think it's about getting ready with a solid business that's making some progress, and the materials to back up your raise.
Mm-hmm. And here's another one. What is the desired MRR to secure a 2 to 5 million investment with valuation from 20 million to 50 million?
Okay, so that'll tend to vary. So 20 million to, so that's kind of somewhere between a seed to a Series A-ish raise, and you're probably not even getting close without $1 million. But so it depends on the category that you're in. And honestly, I'm going to suggest that there's a great graph I recently saw from Carta, actually, on different seed raises by round size and category and industry, and what they've been doing over the last quarter or two. So I don't like to really throw out numbers on it, because it varies a lot by what your business is doing and the trajectory and the pace of your growth. But I think you can pretty easily search that and find some comparables that look like you, and see what the valuations are. I will say that they're kind of declining now in today's climate, but they vary. I don't know what you're seeing for that, Najee. You're kind of in the heart of Silicon Valley, so I don't know if you have a different answer, but I don't like to guess at people's valuation, because every company is a little bit different. But yeah.
Yeah, I would agree with you. I mean, it's a tough question, because it really depends on like the industry that you're in, and as well, like how far you are along. And that doesn't necessarily just mean specifically your MRR, because based on the type of business, there's a lot of different factors involved that will determine your valuation. Right now, I would say expecting to raise 2 to 5 million with like a 50 million valuation as like an early stage company is probably not very likely, unless you are a multi-exit founder and you have a ton of traction and pretty much like don't need the capital at all, because those terms are pretty tough. But yeah, go ahead.
Sorry, I heard you say 15, not 50. I would have reacted differently. So sorry,
50.
Yeah. 2 million at 50 is a very unusual rate. Like that would almost not happen, because like you're talking sort of seedish size check and a sort of series, and these terms move around all the time and the labels are just labels, but you're talking about like sort of a Series A valuation on a seed size check. And those don't tend to go together. An investor that's investing in any given round is probably looking for, 10-15% of the company. And so doing the math, it would just be too small of an opportunity if you were, 50 million valuation at 2 million raised. So that round is relatively unlikely to actually happen.
Yeah.
I've got another question for you too that I've got in the Q&A. So I think this one's good because it's industry specific, but it says, how would you raise funding for a capital intensive business with weak traction? What if the only hard traction metric you can have is signups because it's hard tech, for example, robotic homes, grants and F&F fundraising, it isn't enough for a capital intensive industry?
Mhm.
Right on. So I don't know if I love this question because my venture backed company was hardware, and I tend to be one of the outliers at Techstars and loving my hardware companies too. So I've had a couple hardware companies and 2-3 hardware companies in each of several of my programs, so there are certain categories for which traction is going to look different than revenue because you got to build it first before you can get paying customers. So the traction should still look like evidence that people want to use what you're building. And so if you don't have revenue as your traction, there should kind of be a reason for it. Like if you're building some simple thing that can be consumer sold on an MVP and you haven't done that yet, then it's almost a negative indicator. If you're building something that you need to raise real money before you can get it to market, then that's the reason that you can't have revenue traction, and that at least computes. But what are you doing to demonstrate that once you build it, people will in fact buy? And so there are different ways to do that. I've got I'll give a couple shout outs to companies of mine that are hard tech that I've invested in, but Reeve, which was just in our recent Techstars Future of Longevity Accelerator, is a exoskeleton for stroke survivors to help them walk again, and totally cool technology. And let me tell you how they just raised $1 million plus euros. So first of all, there is some grant financing for that because they are tech geniuses who when they're not building exoskeletons, they were building Martian landing rovers for Europe and winning $1 million prizes at university for working on this research. So you get a sense of their tech chops there. And then they raised capital because they are relentlessly executing against bringing this to market and demonstrating that the market is interested by way of people signing up for test use and by way of the distribution channel saying, yes, if you build this, I would be interested in distributing it. And so that gives investors confidence to write the check for them to be able to build the hardware. But hardware is hard. Deep tech is hard and it's a slog. And so you have to do anything you can to help de-risk it and show that once it's built, people are going to want it. Another company that was building a automated, a next-gen wheelchair. They put up a test site, and for a fraction of the cost of the powered wheelchairs today. Think of it as a smart wheelchair of the future, battery powered. And they put up a test site to pre-sell it with $100 deposits. So they were actually not just like, hey, is this a loosey-goosey customer list, or are people willing to write checks? This company is called Abby by GoGoTech. And they got hundreds of people signing up to give them $100 towards a $3,000 purchase, to the point that he had to take down the website because it was going so quickly. So they were able to demonstrate need pretty clearly, that people were willing to write a small check for a deposit on hardware that might not be available too quickly. So those are some of the examples, but you have to get creative to show that people will buy it. I don't know if you have some different examples, Naji, but that's what comes to mind for me.
No, I was laughing because I also came from the hard tech space, and it is just challenging to raise capital. It's a lot harder. The more money you need before being able to validate that there's a real customer is just difficult. And so I think with weak traction, it's especially difficult. And to your point, you just need to figure out some way to validate that you're going to have some buyers. And I think one of those routes is potentially like having LOIs or having pilot agreements and things like that. And that can be helpful, but you're still selling a dream and not an actual business at that point. So it's going to be challenging.
Yeah. And your point on selling the dream is so important. As a founder, you got to articulate vision. So that's the thing. You got to take that step back and bring people along in your journey. At these early stages of a company, people are hopping on your vision and your team. Like even at tech, like we're very intent. We say the first three things we look for are team, team, team. So be able to articulate your team and then market. So what's the big thing that you can build against this market and tell your story? So you got to be a great storyteller. And we spend a lot of time on all those disciplines in program because it is so important at this early stage.
All right, so just so everyone knows, we've got about 10 minutes left in the session. So maybe if we can get, 2 more questions in, hopefully. Another one that I have that I think is good for you to both to speak on is from Mina Raver. Does it make sense to go through an accelerator before going for venture?
I can take that one. Does it make sense to go through an accelerator before raising venture? I think it's a natural progression of things. It's a nice little step. It's if I'm being completely honest, I don't think it's always necessary and it's not absolutely necessary, but I think you'll find that a lot of companies that do go through an accelerator often do a lot better because there are a lot of unknown unknowns. And when you come in, especially as an early founder or a first time founder rather, there's just a lot you don't know, and having that network and community to really surround you and help you guide you in, how we like to phrase it, is directing your rocket ship, so that once you do get that rocket fuel, which is the investment, you're going to the moon as opposed to into the ground.
Yeah. And I'll add one more layer and so yeah, and I think to not just point, it is the natural progression. I mean, usually accelerator is the path to then addressing later stage venture, not the reverse. So I'm a multi-time founder. I've raised a lot of venture capital. I know how to do this already. I teach it. If I were starting another startup, I would go through a Techstars Accelerator again. And the reason being is just because I know the content. The fact that Techstars surrounds a startup with this curated mentorship and this infrastructure of other founders going through the journey together, you really do take a lot of time off of the exercise by getting surrounded by subject matter experts in the field and others working on it to, again, more rapidly knock down dead ends and address upside opportunities through this connection to these curated meetings that are really hard to get one-on-one. I could get access to all the same people, but it would take me a year. To be able to do that in 3 weeks of mentor magic, and then have a few of them already signed up to help me out because they were dedicating weeks of mentorship after that initial period to a handful of companies, is just so game changing in the pace that you can avoid dead ends and find a good path. So I think it's valuable to anyone. I obviously, I'm drinking the Kool-Aid here, but I've been helping startups for a decade, for the last 5 years doing it here because it's such a powerful platform.
All right, I have one more, and I'm going to modify it a little bit just to make it more applicable to everyone that's in the conversation. But so a lot of initial introductions to investors can happen in sort of an ad hoc manner and not necessarily super structured. And it'll end with, send me your email or, send me some information. What sort of information should you be including in that first, I guess, digital touch point so that you have that information available in the future meetings?
In response to send me some information, was that the question?
Yeah, the question was, should I include forecasted customer growth, or is it too early to be trying to forecast something like that? So I guess what sort of details should you be including in that first touch point?
Yeah, so let me address that a little bit. So think of the investor and they'll go into this more in the next couple of weeks of sessions. But the way we cover this in program is that the progression from lead to closed venture deal is a progression. You're not going to get there in one shot. This is the initial ask out on a date to marriage is probably not going to happen on the first step. And so the goal, what we go through is the goal of your initial outreach is to get the first meeting. That's it. Think of it as, you're doing the movie trailer to try to get me to watch the movie. You're not releasing the whole movie. You're not telling me how it ends. You're just giving me the snippet. The goal of the first meeting also is not to close. The goal of the first meeting is to get the second meeting. Once you've gotten the second meeting and once they're drilling down and getting into the details, now you can start moving towards like, okay, like, are you interested? Are we getting term sheets? Is there a data room here? But so with that in mind, you want to get them to, they're going to be really quick. They're making a quick judgment on, should I spend a half hour with you? With that in mind, there's some core elements of what to cover in a one pager. You can just kind of Google like what's in a one pager or look at the Techstars toolkit for this. But it's basic stuff: problem, solution, market size, initial traction, not detailed forecast, none of that. Maybe there's something about the growth going up and to the right, but it's not a financial model. And never send your investor deck before you have the investor meeting. They'll ask for it because it's a convenient way for them to pre-screen out, but you want to be the one voicing over your deck. So again, think of it as movie trailer, not movie, and think of it as a one pager with a paragraph about what you do, kind of the elevator pitch version.
Najee, anything from you, or should we move on to maybe one more question?
No, I mean, I agree with a lot of what Keith said. I think for me, it's like when someone says like, hey, can you just shoot me some information? Like if I say that to you, I'm typically asking for like a deck. I would like to kind of see a deck. I definitely don't want I don't need like financial models and things like that. Like that's probably a little excessive. But even like a solid blurb with some bullet points of like, these are the key things that have gone on, and like, can we have a meeting? I would take that too. I don't necessarily need so much information, and honestly, too much information can be a little bit difficult to digest, especially in just the daily flow of things. So it doesn't always help you in that regard.
Yeah, it's a 2-minute decision on whether or not to spend more time, so it's got to be quick. I saw this in the chat as well on decks. So how do you avoid sending a deck when you're asked? And we might be saying something similar here, which is that if you have to send it as a deck, think about converting your one pager to deck form so it appears as a deck, but it's not the full thing that you would present when you have a 30-minute meeting with someone. So there's a little bit of a hold. It's still kind of a movie trailer version of your presentation deck, which might be more comprehensive and have more drill down into financial model and other things. So that's kind of the hack, is the one pager and the deck are fairly similar for an initial send out.
Awesome. Thanks so much. All right. So last question. We got a few minutes left. This is from Pilar Zarate. Apologize again if I pronounce your name correctly, but the question is, how can you effectively justify and defend your valuation when raising a seed or pre-seed round using safes? Is comparing your valuation to industry standards sufficient, or are there additional factors to consider?
Could you repeat that?
Yeah, it's defending. How do you defend your valuation? Really, it was on safes, but it really is in any round. And I would say that your best defense to valuation is competition for the round. Right? So let a market is what a willing buyer and willing seller are going to agree to. It is a tough climate. So valuations are certainly getting tight. So for some, knowledge of the comps is really valuable because it'll set your own expectations, and it is something to hang your hat on when talking to someone. But if they're comfortable only a certain valuation, ultimately the best way to drive up valuation is have others who are interested and create a little bit of a market. And that's even in my case with my own rounds and also in our approach to raising capital. Even for your top choice investors, you might like one investor better than another one and say, hey, I'd like that person on my board and on my cap table, but they're a little bit too low. Having someone else compete with them and just saying and being able to say with a straight face, hey, I really want to go with you, but I've got an offer that's way higher than that. Can you at least like meet us in the middle here so we get a little closer? So that is something that can work. But usually if it's just, what your number is and what their number is, it's a little bit hard to get people to move.
All right. That is all we have time for, everyone. Thank you so much for attending and for all of your amazing questions. Keith and Najee, awesome job. Can you just share the best way for everyone to get in contact with you following the session?
Yeah, okay, go ahead.
You feel free to reach, as I said, feel free to reach out to me on LinkedIn. You can find my profile. It's my name, just like that, Najee Barnes McFarlane. And if it's really difficult, Najee and Techstars, and you'll probably find me too. And yeah, I'm happy to chat over there and can follow up via email, et cetera, after that.
Yeah, it's same for me. LinkedIn is best. That's where I put out most of my stuff. So you can find me there. I'm also at Kate Camhigh, first initial last name, at Twitter. And I'll put out that vision execution map document on both platforms, so you can find me either place.
Wonderful. Well, everyone have a nice day, and we will see you all at the next fundraising session. Thanks, guys.
Pleasure. Good to see you.